Gold breaches $5,000 and currency markets signal global recalibration. We wanted to talk to you about the yen intervention risk, Singapore dollar strength, and the precious metal rally. Let's do a deep dive. Let's try and understand what's happening in the global markets. Let's start with gold at $5,000. The debasement trade in full force. Gold climbed over 2% to above $5,085 on Monday as dollar weaknesses reinforced demand. The metal has more than doubled over the past 2 years and has risen over 17% in 2026 alone, following its strongest annual performance since 1979. The primary driver is the debasement rate, wherein investors retreat from sovereign bonds and currencies into hard assets that cannot be printed or debased through fiscal expansion. Central bank purchasing provides structural support, with net global purchases roughly doubling compared to the pre-2022 levels. Bank of America now sees gold potentially reaching $6,000 by the spring of 2026, while JP Morgan forecasts $5,055 for Q4 of 2026. Family offices focused on generational wealth preservation have increasingly allocated to bullion, representing a structural shift in the demand beyond short-term speculation. From gold, now let's move on to yen. The yen intervention and the markets on high alert. The yen surged approximately 1.75% in a single session following reports that the New York Federal Reserve conducted rate checks with major financial institutions. This has placed markets on alert on what could be the first coordinated US-Japan intervention in 15 years. Japanese authorities did confirm close coordination with US, with the Prime Minister stating that the government would take necessary steps against speculative moves. The US participation in currency intervention is extremely rare, with the most recent instance in March of 2011 following the Tohoku earthquake. The speculation about the potential coordination, sometimes called the Mar-a-Lago Accord, echoing the 1985 Plaza Accord, reflects growing concerns about the dollar's strength and its impact on Asian currencies. When we are talking about the Asian currencies, let's now focus on the Singapore dollar, which is Asia's emerging safe haven. The Singapore dollar strengthened to its highest level against the greenback since late 2014, with the USD Singapore dollar falling to 1.2679. Singapore government securities have outperformed the global peers, attracting flight to quality inflows from investors wary of fiscal risks in US as well as in Europe. The firmness of the trade-weighted Singapore dollar serves as evidence of the country's safe haven appeal. The Singapore dollar nominal effective exchange rate is trading approximately 1.89% above the implied midpoint of MAS policy band, placing the currency near the top of its estimated range. Some of the analysts suggest that Singapore dollar could become the Swiss franc of Asia, with Jefferies forecasting potential dollar parity within 5 years. Let's also talk about Switzerland and the broader precious metal rally. The Swiss franc has outperformed all its G10 peers, reaffirming its role as the ultimate safe haven currency. Switzerland's appeal rests on its political neutrality, low inflation, high current account surplus, and the confidence in the Swiss National Bank. The near-zero interest rates paradoxically support the franc, as limited scope for aggressive easing leaves the currency structurally well supported during the risk-off episodes.